a lot of people are telling you, and I actually agree with this, that over the next 10 years, the dollar will essentially start to lose its reserve currency status and degrade, partially because, I mean, in all fairness, a lot because of money printing as well as the U.S. national debt. This is going to be the tricky thing, folks, and this is what's going to screw a lot of people and create a very tough stock market picture, right? So if we look at this and we see, and let's just say the dollar trends lower, right? The dollar trends lower over time, whether it goes here, whether it goes here. A dollar that's declining means that asset prices, mainly commodities, are going to have to go higher. If commodity prices go higher, that's inflationary. It's another reason why I believe that over the next 10 years, inflation is not going back to 2%. It's probably going to stay around 3+%.
U.S. consumer spending is on track to drive third quarter GDP growth of perhaps 3 to 3.5%. However, this is not sustainable. American consumers are running down savings and using their credit cards to finance a large proportion of this. With financial stresses becoming more apparent and student loan repayments restarting, a correction is coming. Federal Reserve's favored measure of inflation, the core personal consumer expenditure deflator, which is a broader measure of prices than the CPI measure that is more widely known. It rose 0.2% month-on-month for the second consecutive month, which is what we want to see, as over time, that sort of figure will get annual inflation trending down to 2% quite happily. However, according to Gareth Soloway, it would take not less than 10 years for inflation to go back to 2%, and that is if it eventually does, which he doubts. He presents his reasons in the video below and believes that the government has more work to do. The slight negative is the core services ex-housing, which the Fed is watching carefully due to it being more influenced by labor input costs. It posted a 0.46% MOM increase after a 0.3% gain in June, so we are not seeing much of a slowdown in the year-on-year rate yet. With unemployment at just 3.5%, a tight jobs market could keep wage pressures elevated and mean inflation stays higher for longer, so we could hear some hawkishness from some Fed officials on the back of this. Nonetheless, the market is seemingly shrugging this off right now, given signs of slackening in the labor market from the latest job openings data and the Challenger job layoff series. Let's now get back into the video. Don't forget to like it, subscribe, and drop comments below.
We've talked about how inflation was trading or at 9%. And bringing it down to around 3% or so is the easy battle. 3 to 2 is the tough battle. And I'll go on record right now predicting that there will be a point in 2024 when we're still around 3% inflation and the Fed still starts to lower interest rates. There's going to be a new normal. The Fed has said 2% is what they want. They'll eventually adjust that to 3% inflation because it's going to be nearly impossible to get the cat back in the bag and get inflation at 2%. Now, when we look at this, it makes it sound like the PCE data was horrendous this morning. Yet the S&P market, the S&P futures, are actually positive. Now, they haven't really gone anywhere since the data was released this morning, but I want to jump over to this chart over here, or these data points. Now, here's the data points that were released today, and I want to show you why the markets are not really freaking out that the inflation fight is getting tougher. And we're going to go first to jobless claims. So we have jobless claims right here. And the key on this, folks, is that you could see that today jobless claims came in at 228,000, and that was actually down 4,000 from last week, so week over week. And so interestingly enough, and we're going to get to the inflation numbers in a second, they're right down here, but the jobless claims, again, this is people filing for unemployment. They actually came down. Now remember, we saw the JOLTS numbers earlier this week that the market really loved because the JOLTS numbers was people or job openings. And job openings declined dramatically. But we're not seeing the labor market weaken per jobless claims just yet. So I think that's interesting to take note of. All right, so next up, let's take the next point here. And I want to go into the next factor. And the next factor was the core PCE data. Now, the core PCE data came in at 0.2% month over month, but this is the kicker, all right, right here. What was the estimate? The estimate was 0.2%. And so even though we're generally seeing inflation being tougher to bring down, the market already knew that going into the data. So again, because this is equal to this, the markets aren't freaking out about it. Essentially, it came in at expectations. Going to the 12-month PCE, which is year over year, 4.2%. Experts had expected 4.2%. So right on alignment there. Lastly, we have personal income. Personal income did decline a little, which is a small positive. Well, listen, that's not fair. Personal income in general, you and me, we want people to make more money. The Federal Reserve does not. The reason they don't want people to make more money is because it causes inflation to go up. All right, so they like the fact that it came in at 0.2% versus estimates of 0.3. It's a very minor thing, but that is a small positive. The other side of the coin is a small negative. So this was a small positive. This one, personal spending, is a small negative because personal spending dropped. And that tells you that the consumer and expectations were 0.7% and it came in at 0.6%. And that tells you that consumers are pulling back just a hair on their spending habit.
The Fed started hiking interest rates in March 2022, and inflation has since fallen from four-decade highs to just 3.2% as of last month. Despite doomsayers' warnings earlier this year, its aggressive tightening campaign is yet to crater the labor market. The U.S. unemployment rate is still hovering below 3.5%, and Morgan Stanley expects the August non-farm payrolls report set to be released Friday to show the economy added 155,000 more jobs this month. Meanwhile, growth has remained resilient, with the economy expanding 2.1% between April and June, according to a government estimate Wednesday. Gareth expands more on this as he also complains of the high prices of commodity and his outlook for Bitcoin, costly orange juice. Bitcoin is uncertain.
People are talking about that the dollar is going to go down, and I agree with this. And this is going to be an interesting little concept. Let's go back to the DXY chart here. All right, so here's your DXY chart. Now, in terms of the dollar, let's talk bigger picture. Let's go to our monthly chart. So if we go to our monthly chart on the dollar, here it is, what we can see, and these are these two smaller trend lines over here, but we can see that we have this pivot top going back to 2002, and we now have this level here. So the first thing in terms of drawing trend lines, I always put my trend lines in first, right? And so basically I would take that high and draw it down to the secondary high that we made in basically a year ago or so right here. So this is your new trend line to watch here. Now, a lot of people are telling you, and I actually agree with this, that over the next 10 years, the dollar will essentially start to lose its reserve currency status and degrade, partially because, in all fairness, a lot because of money printing as well as the U.S. national debt. This is going to be the tricky thing, folks, and this is what's going to screw a lot of people and create a very tough stock market picture, right? So if we look at this and we see, and let's just say the dollar trends lower, right? The dollar trends lower over time, whether it goes here, whether it goes here. A dollar that's declining means that asset prices, mainly commodities, are going to have to go higher. If commodity prices go higher, that's inflationary. It's another reason why I believe that over the next 10 years, inflation is not going back to 2%. It's probably going to stay around 3+% going forward, because if the dollar declines, then we know commodities are going to go up. By the way, take a look at the orange juice futures market right now. Orange juice is like this. It's an incredible move on orange juice. You can pull that chart up. I don't think they have that. I don't know, actually. Let me see if they have that on TradingView, but it is an insane chart here on orange juice. All right, let me just take a look here and see if we have. Hey, we do. Let's see if it shows here. Oh, yeah, look at this, guys. Look at orange juice. I was actually looking for an ETF to short this. I couldn't find one, though, unfortunately. But look at the move in orange juice here. This literally is up 200% since 2021 lows. All right, that is a remarkable move to the upside. And by the way, I'm not a big person that buys orange juice at the store, but if you are, I'm sure you've noticed the cost of orange juice has gone skyrocketing to the upside. All right, so that's a couple charts. There was a chart there. I just want to go over a couple crypto charts here real quick. If we look at Bitcoin, there's not a whole lot new today. We're still retracing. The question again for me when I look at this chart on Bitcoin is, are we making a bull flag, which would be bullish for a move up here to 28.5 to 29,000, or are we going to retrace down here, which would be then bearish? So as a technician, I let the charts tell me. And the charts, again, it's too preliminary to know, but if we stay inside here, this would be bullish. If we start breaking lower, that would be bearish. And it's all about the formation. By looking at formations in charts, you know that in history, 1,000, 1,000,000 of these formations, 7 out of 10, 8 out of 10 of these, or 800 out of 1,000, whatever it may be, they work out in this direction. And that's what technical analysis is.
The $2.2 trillion of excess savings accumulated during the pandemic, $1.3 trillion has already been spent. At the current run rate, it will all be gone by the end of the second quarter of 2024, and for low and middle income, that point will come far sooner. With banks far more reluctant to provide unsecured consumer credit based on the Federal Reserve's Senior Loan Officer Opinion Survey, the clear threat is that many struggling households may soon find their credit cards are being maxed out and they can't obtain more credit. With student loan repayments restarting, we expect consumer spending to slow meaningfully from the late fourth quarter onwards and turn negative in early 2024. Bitcoin briefly dropped below $26,000 early this morning as optimism around the approval of a Bitcoin ETF application was again delayed. Yesterday, the SEC extended the deadline to approve or deny 6 ETF decisions by 45 days, citing the need for additional time to evaluate the applications. The negative price movement over the past day reversed the bullish gains in Bitcoin following the Grayscale court decision earlier on August 29. The U.S. Court of Appeals for the D.C. Circuit overturned the SEC decision to block Grayscale from converting its Bitcoin Trust, GBTC, to a spot Bitcoin ETF, ordering the commission to review the application again. The ruling raised hopes of imminent approval, pushing Bitcoin's price surged to a peak near $28,000 per CoinGecko on Wednesday after the court's verdict came out. Another delay from the securities regulator crushed the market's optimism, however, sending Bitcoin prices back towards $26,000. Ether followed the top cryptocurrency with a 3.5% dip since yesterday. The crypto market cap declined by 3.5%, losing $11.2 billion overnight. What do you think of Gareth Soloway's analysis of the market? Feel free to drop your comments, like this video, and turn on notifications.